Good evening friends, welcome to Big Bull channel. Friends, today we'll be analyzing a company called Hindustan Foods Limited. It is a small cap company but a very big multi-bagger. Let us see the history of Hindustan Foods Company. Initially it was owned by a company called Depot Foods, which was its holding company, and it used to manufacture single brand product called Fairex, that was a nutritional food product for infants, and it was loss making company. But in 2013 the company was purchased by Vanity Case, and instead of single brand manufacturing, it changed its business model to contract manufacturing, and it manufactured wider products for many companies, and it was profitable. So this is a big turnaround story from which a loss making company became a multi-bagger. So now friends, let us see what is contract manufacturing. In contract manufacturing, this is the company Hindustan Foods. It goes into a contract with any company, say X. For example, in our case, let us take the example of X to be HUL, Hindustan Unilever Limited. This is an FMCG company. It manufactures different products and sells in different brands name. So Hindustan Unilever shares the technical know-how or IPR, technical know-how, to Hindustan Foods, and the Hindustan Foods Limited, they manufacture in bulk and sends either the part of the constituents for HUL to assemble it or the complete product depending on the contract. So this whole business is called contract manufacturing. So what is the advantage of contract manufacturing? The advantage is HUL, after developing the product, it can further spend its energy on development of further products. It can do research and development, and it can focus on its area of core competency. It need not waste its energy in producing bulk quantities, which is done by a contract by another company. And what is the benefit? Other benefits are, since this contract manufacturing company manufactures these products for different companies, not just HUL, for n number of companies, they have economies of scale, they have cost efficiency, they are faster in the market, faster to the market, and at the same time the other company can focus on its own core competency. So this is the advantage of contract manufacturing, in which both the clientele as well as the parent company both are benefited. So now the products which are all manufactured by Hindustan Foods. First is personal care. In personal care, it manufactures hair care, shampoos, hair oil, etc., toiletries and fragrance, baby care, skin care, and food and beverages. Food items like powderages, instant mixes, soups, spices, masala, jams, muesli, etc. Beverages, carbonated soft drinks, ice creams, tea, coffee, malt based foods, soups, glucose, etc. And it also does home care products like liquid detergent, powder detergent, and home care products like surface cleansers, glass cleansers, liquid dishwash. It also has wider products in household insecticides like liquid vaporizer, aerosols, mosquito mats, mosquito coils. And not just FMCG, it also manufactures products that are in footwear sector like leather, footwear, women's footwear, flip-flops, etc. And apart from this, it also manufactures products for health and wellness like vitamins and minerals, nutrition elements, digestive remedies, oral liquids, etc. And it is also having a segment for pet care, pet hygiene, and pet food. So these are the companies for which, as I mentioned earlier, the company to which Hindustan Food goes into a long-term contract. These are the companies in which it is having contract. So it ranges from vast segment of companies, like it has FMCG companies like Hindustan Unilever, Marico, and it has retail companies like DMart, Reliance. It has a footwear company like Bata. It has consumer durables like Godrej, consumer products, Tata Consumer Products, and pharmaceutical companies like Zydus Wellness, another FMCG ITC, beverages like Hector Beverages, PepsiCo, Lakme. So you can see in this chart itself, it caters to large number of FMCG companies as well as non-FMCG companies. So let us analyze the performance of the company. So Hindustan Foods is a small cap company with market cap of just 6,652 crores. Stock P is price to earning multiple is 83. So which shows that it is bit overvalued, but generally FMCG companies has high PE multiple, and this is a contract manufacturing mostly catering to FMCG and consumer products, hence its PE is high. And high PE shows that in market the demand of the stock is high. And ROCE and ROE both are almost 20, 18 ROCE and 20 ROE return on equity. It is very good. And if we see the sales, if we see the debt to equity is 1.36, which is bit more. Anything less than 1 is ideal. So we'll discuss this debt to equity in detail later also. So this is the performance from 2013, since when the company became profitable. We can see that steady rise in share price, and till now, that is as on date, the company has performed. 1 rupee invested in 2012 is 583 rupees today. It has multiplied your investors wealth by nearly 580 times. 1 rupee invested is like 584 rupees today. So this is a huge wealth creator in market. So this is the price chart as well as the valuation chart. So if we see, friends, the price chart, steadily it is increasing and then consolidating, consolidating. There is a gradual steady increase of share price for the past decade. So it shows a very good linear, very good increase in share price. And second thing is, if you see the EPS, earning per multiple, these blocks are EPS, earning per multiple, earning per share multiple. It has steadily increased. EPS has steadily increased. And if you see this chart is a valuation chart, price to earning multiple. See, the 10-year average median PE, price to earning, is 90, and present PE is less than 10-year average PE. 10-year average PE is 90.7 and present is almost 80 to 90, which means that present valuation of share is not that much overvalued. It cannot be said that it is too undervalued, but it is fair in valuation. So this steady increase in EPS and steady rise in share price, all these are pointing to that the company has very strong fundamentals. So let us analyze the quarterly results of the company. So friends, if we see sales of the company has gradually and steadily increased from 200 crores in 2020 to 457 crores in 2021 and to 598 crores in 2022 and 619 crores in 2023. There is a steady increase, but of the last quarter the performance is flattish. From 660 crores there is a slight decrease in revenue. There is a reason for that, which I will explain. First reason is fall in commodity prices. In the last quarter, commodity prices of most of the products produced by Hindustan Foods fell, and Hindustan Foods just passes on the price variation in the market to the customer. So any increase, any inflation, the revenue will increase. Any deflation or decrease in price, the revenue will fall. So that is one reason. In its investor statement, it has mentioned that commodity prices for tea and all fell nearly 25%, and for other beverages manufacturing products fell nearly by 40%. So this is the reason for flattish numbers in revenue, but this is an external factor. There is no issue with the internal working of the company. So, and this is a temporary issue. And second thing is because of unseasonal rainfall. Last quarter is the summer quarter, and because of unseasonal rainfall, the demand of beverages and ice creams decreased. Thereby, the revenue, the sales of ice creams and beverages decreased, hence flattish in revenue. But still, the profit after tax, net profit, is almost same. So friends, I would say this performance, though it is not very good, but it is only because of external pressures and nothing to do with the internal factors of the company. And the management has said that in the very next quarter onwards, the figure will be very good. And this is with respect to long-term sales and profit. If we see, this is an outstanding data. from 500 crores in 2019. In 4 years it has almost the sales has increased by 5 times. From 500 crores it has become 2500 crores. And if we see the profit from 33 crores, it has increased to more than 150 crores. That is more than 5x 173 crores. So in 5 years the performance of the company is more than 5x times, and hence the long term CAGR of stock is 75%. That is, the invested amount is compounded at the CAGR of CAG rate of 75%. This is an outstanding figure. So friends, let us see the shareholding pattern of this company. Promoters have high stakehold, and from 62 percentage the promoters have increased from 62 percentage from 2020 to 64.85. So promoters are buying the company. So any increase in promoter shareholding shows that promoters are the best people to know the whereabouts of the company, to know whether the company is profitable, whether the business model exactly. So if the promoter is having the trust on the company, and if they are increasing their stake, it is a very good sign. And then FIDIA almost are having same percentage, almost 13% is held by FIDIA. So overall the institution shareholding is almost close to 78-80%. That is very good. So if we see the last year's performance, consolidated figure of last year, now you will be understanding why I am discussing this company and saying this company is having strong fundamentals. The revenue is steadily increasing from financial year 2018 to 2023. There is not a single year, even though there was COVID in between, there is a steady increase of revenue. And in financial year 2023 the achieved figure was 2600 crores. But company has said in financial year 2025 the projected revenue company has targeted is 4000 crores. So this is a very ambitious target, and the management is confident that they will achieve this target. This figure is in investor presentation. So second thing, the profit after tax, PAT has also increased steadily from 6 crores to 71 crores, and EBITDA has also increased from 13 crores to 178 crores. So friends, if we see this graph, from every parameter, revenue, EBITDA, performance after tax, everything, it is steadily increasing. This sense it has strong fundamentals. Friends, I would also say, despite I am mentioning all the positive things of the company, there is two risk factors which I would like to mention. One thing is its borrowings. If we see, the borrowings of the company has steadily increased from last 4 years, from nearly 100 crores to 500 crores. So because of this increase in borrowing, we saw that debt to equity ratio was more than 1. It was exactly 1.36. So you can ask me, what is the problem if the company is borrowing? The problem is, once the company starts borrowing more, it has to pay interest more, and once the company is paying interest out of its profit, the profit figure shown by the company will reduce, and EPS figure will reduce, and hence the valuation correction will happen and share price will tank, or share price might fall. This is the reason why borrowing or debt to equity should not be more. But this is a unique case. If the borrowing is used for capex or capital investment to make a better return on equity, then the borrowing is good. What I mean to say is, if the company is borrowing money to invest in new businesses, or to grow more, to grow its revenue, to grow its profit more, and then showing exponential rise in profits, then automatically this profit will increase, and it can easily lend back the money, and hence there will not be any issue with share price. Rather, share price will appreciate. So these borrowings were for these purposes. It has recently started an ice cream project in Uttar Pradesh. Hyderabad, it has started a bath soaps and detergent manufacturing unit. A greenfield unit is set up in Guwahati, and recently it is acquiring a company in Badi. So because of continuous organic and inorganic growth, this is the main reason why it is borrowing. It is borrowing only to expand its growth, which is a good sign. And second important risk is high operational risk. The whole working of the company is with respect to the contracts. So it it goes for long term contracts with different companies, 5 to 10 years contracts. Any failure to renew the contract, which means it will definitely impact its revenue and profit. So timely renewal of contract is one thing which is to be noted. But since it has already built up its brand value, it generally it never happened that the contract got cancelled. So friends, let us see the technical aspects of Hindustan Foods. The company's share price follows a pattern. There is a steady rise and then there is a consolidation, and there is a steady rise and then there is a consolidation. So from the chart you would have known that presently the company is in consolidation phase. Though last few days, last 1 or 2 trading sessions, the share price has sharply jumped and the RSI is in overbought zone, but still it has not broken the last 1 year consolidation. So it is a right time to buy. And from, if you see from top, it is at 16% discount from all time high, and the support, the long term support is this 500 is long term support, and the resistance is at 650. There is a small resistance and larger resistance at 750. So if it breaks 750, then it can go for another steep increase in share price. So this is all, friends. I have discussed the risks as well as the fundamentals of the company called Hindustan Foods. Thank you.